And so now the CFPB has come to the real estate and mortgage world. And so they're regulating banks because their interest is to protect consumers. So two big laws that have come out, or two big changes, I would say, that have come out in 2015 are going to take effect August 1st. And they are going to affect the transaction in a couple of ways, which I'll talk about in a second. But the reason, so there's two things. The first is a loan estimate, right, which is required by lenders to give to consumers or borrowers 3 days, no later than 3 days after they have an application. Okay, so that's number one. They're going to have to give a loan estimate.
Okay.
The second is that there's a new closing disclosure form, which takes place of the HUD and the truth in lending form. So
is it more thorough or easier to comprehend?
That's a great question. So more, I think that's a lot of the debate that's going on right now in our industry, because the intention is that it's more easy to comprehend. Right, so the Consumer Financial Protection Bureau went out and got a lot of feedback from people, and they redesigned what we've been using for years and years and years, which is the HUD, combined it with the Truth in Lending form, and the intention was that that is going to be easy to understand for consumers, for borrowers. Right, so that's the intention behind it. Whether that's actually happening or not, I think is still yet to be determined. Right, whether it actually is, because it's, you know, a lot of these documents, when you're a buyer, especially if you're a first-time buyer, are really overwhelming to understand, and it's all about crunch time at the end of a transaction. And so there's a couple of things that the Consumer Financial Protection Bureau has done to slow down the end of a transaction, which is really going to affect our closing dates.
Right.
And so one of those is, well, there's two things. At the beginning of the transaction, you could delay the beginning of the process up to 10 days because the borrower has to sign the intent to proceed after an application is given. So a lender takes an application. That lender then has 3 days to give them a loan estimate. So it was the good faith estimate in prior years. It's now a loan estimate, right? They have 3 days to do that. What has been often the practice is, as soon as I get an application from a borrower, I order an appraisal.
Okay.
Right? Well, an appraisal costs something to the borrower if that loan goes through. Loan estimate, which has to be delivered within 3 days, the borrower then has 10 days to review it. They can review it the same day and send it back, and then you can order an appraisal.
But worst case scenario,
they have 10 days to review it.
After that third day.
After they, correct.
So the full countdown is 13 days.
Correct. And I think that there's some things that lenders are going to do. For example, try to get that good faith estimate out the same day that they do the one, because they're gonna be time crunched. We're all going to be time crunched to make sure that we're getting things out so that consumers can review, right? The whole purpose of a lot of this is to slow down the transaction so a consumer, a borrower, right, somebody who's buying a house, who's got all of this information that is getting thrown at them, can digest the information in a way and make good decisions about it. But if a buyer has all of their ducks in a row, so it's easy for them to provide the information that the lenders need, they have their taxes, they have all that, if they have that organized in advance, it creates more smooth sailing in the transaction after.
It's very important because a pre-qual is basically a phone call and a chit-chat.
Hey, how much do you make?
Pre-approval is actually a pre-approval with the loan processor.
Correct.
And underwriting approval, the grand finale, is with the actual underwriter before loan docs, right before loan docs are prepared.
Correct.
So there is an importance of this procedure as far as negotiating power.
Correct.
And it's getting borrowers prepared more in advance than I think that we're having them get prepared now. Sometimes it's, it would be nice to get all that stuff in a row, but now it's going to be really, really critical, or that you're going to see delays in the transaction. So the Consumer Financial Protection Bureau is talking about a word called consummation. Consummation is kind of a new word for closing. Consummation is when a borrower or buyer signs loan docs and is contractually, they've consummated their contractual relationship with the lender to borrow money to purchase a house. Right? So that is the signing of loan docs. So before a borrower can sign loan docs, they have to be able to review that closing disclosure, the new easy-to-read 5-page closing disclosure with all of the fees and everything on it. They need 3 days to review that before they're allowed to sign loan docs.
Oh.
Okay? So you have the date that you're signing loan docs. They need to receive those loan docs 3 days before they can sign. The CFPB says, well, if you email them or you mail them, you have to allow 3 days for them to receive it. Okay? So you can count it as received 3 days after you mail it, or 3 days after you email it. So you can, I mean, there are some cases where you can actually physically hand this disclosure form to a borrower because they live right next door, and they can come down, they can pick it up, and then you don't need to wait that 3 days, it's 1 day. But you're really looking at 6 days between when you generate a closing disclosure form, you send it to a borrower, they review it, and can now sign loan documents, which then go back, right? We fund, record, close. So this time frame is designed to slow down the process so that borrowers can review the documents. And it's supposed to be in their best interest, which I believe, I really like the fact that they need to really understand and see what they're getting into. The tricky part of this is, so this would be great if everything was kind of the same, and every house and every loan and everything, it would be very, very easy to standardize and say, okay, this is how it is, and we can adjust to the new world. The interesting thing is how real estate transactions are done. A lot of things changed in that last 6 days. Right? So the borrower could decide that they wanted a new loan product. They're going to switch to a 5-1 instead of a 30-year fix or a 15-year fix. Or the APR changes substantially, right? Meaning like an 1/8%. Or which was going to require a new disclosure, which then pushes that 3 days and 3 days out. So I think the biggest thing that we're going to see in 2015 is transactions that are not going to be 30 days long. And even some of the major banks like Wells Fargo have publicly stated, 30-day transactions are going to be really, really difficult, if not impossible to do. And the new norm might be 45 days. So it's just something to be able to educate your borrowers on as it relates to how quickly we're going to be able to close these transactions. And that's what really affects the escrow industry. And so we're working with lenders day and night to really try to streamline this process. We've updated our software to make sure that we're going to be able to comply with a lot of the new disclosure rules, and we're providing our people a lot of training to do it.
Wonderful.